Welcome back to BullionIQ, the place where we break down the biggest moves in cryptocurrency so you can understand them before the crowd even notices. Today we're diving into something massive. Over $500 million has already flooded into spot XRP ETFs in under just 12 days. That's not just impressive, it's historic. When institutional buyers step into XRP this aggressively, it's a signal that something huge is happening behind the scenes. Unlike Bitcoin's ETF launches, which took months to catch momentum, XRP is moving forward immediately. That should make everyone stop and think, why is XRP behaving differently? How high could it go as more ETFs come online? We're going to unpack all of this in simple, easy-to-understand terms. If you want to be early on the next major crypto shifts, hit like, subscribe, and turn on notifications. That way, you never miss an update from this channel. For those serious about positioning themselves like top early adopters, I've created the XRP Millionaire Blueprint, a roadmap covering mindset, strategy, and positioning for life-changing outcomes. There's even a pro version with weekly insider reports. Everything you need is pinned in the comments below. Institutional behavior around XRP isn't just strong, it's aggressive. Reports show that between $600 million to $800 million worth of XRP has already been scooped up through over-the-counter OTC dark pools. Jake Claver pointed out that these OTC desks likely hold about 1.5 to 2 billion XRP for institutional sourcing. But here's the kicker, the supply is already being drained and fast. Once these OTC sources dry up, ETF issuers will have only one option left: buying from the open market where retail holders like you and me exist. That's where upward price pressure can go from steady to explosive. Coinbase has become the primary custodian for nearly all XRP ETF holdings, meaning big transfers of XRP into Coinbase wallets aren't retail activity. They're institutions positioning for the long term. Franklin Templeton recently executed a single-minute volume spike of $7.9 million. That's not a casual retail trade. That's serious institutional buy power in action. Right now, 4 US-based spot XRP ETFs are live, with total assets under management hovering around $600 to $650 million at an approximate XRP price of $2. That's over 300 million XRP units already locked away. These numbers fluctuate daily, but the direction is clearly up. Breaking it down further, Osprey holds around $100 million in assets, Canary Capital between $250 and $306 million, and Franklin and Grayscale are growing, currently around $12 million each. Once major wirehouses allow financial advisors to allocate client capital, each new entrant adds additional demand. Liquidity shrinks, scarcity rises, and prices respond. Analysts suggest that over $1.6 billion worth of XRP may have already been acquired through institutional channels, though confirmed data is lower. Even just the verified numbers show this is the early stage of something bigger than hype. Globally, regulation and institutional adoption are accelerating. The UK is learning from first movers and setting a framework to allow overseas stablecoins like RLUSD to circulate. This isn't just about growth, it's about integrating global banking systems into crypto infrastructure. Meanwhile, S&P downgraded Tether's UST to the lowest stability rating, highlighting real concerns about transparency and reserves. When stablecoins like USTD face stress, demand shifts to safer alternatives like USCD or RLUSD, and XRP is positioned at the center of enterprise-grade stablecoin infrastructure. Even small developments, like Texas officially buying Bitcoin for its treasury, show institutional attention. XRP, Solana, Chainlink, and XLM are foundational rails of real-world utility. And as capital realizes this, XRP sits directly in that flow. Technicals align as well, with yearly charts forming a massive cup and handle pattern, a historically bullish setup. Add in structural adoption, ETF acceleration, and supply depletion, and you have a perfect storm building. This isn't hype, it's structural change. Institutional capital, regulatory clarity, and global adoption are aligning to create a multi-year trajectory. The quiet accumulation phase is where the asymmetrical opportunity exists, and those who understand infrastructure, not just price, are the ones who position for life-changing gains. Let's dig deeper into what's really happening behind the scenes. The XRP market is quietly being transformed, and most retail investors don't even realize it yet. Between 600 million and 800 million of XRP has already moved through OTC dark pools, and reports suggest there may be 1.5 to 2 billion XRP sitting on these desks ready for institutional sourcing. But the supply is being drained fast, and once it's gone, the only XRP left will be on public exchanges where retail investors trade. That's when price moves from steady growth to explosive. Coinbase is acting as the main custodian for nearly all of these ETF holdings. Transfers into Coinbase wallets aren't just numbers on a screen. They represent long-term cold storage. Institutions aren't here for day trading. They are accumulating for multi-year growth. Even single-minute spikes of millions in volume, like the 7.9 million from Franklin Templeton, aren't retail noise. They're serious buy signals. When these institutions run out of OTC supply, ETFs will have no choice but to compete for XRP in the open market, pushing scarcity higher and prices upward. Right now, 4 US-based spot XRP ETFs are live, and their combined assets under management hover between $600 million and $650 million. Using a $2 XRP price, that's over 300 million units already locked away. Osprey is close to 100 million, Canary Capital is around 250, 306 million, and Franklin and Grayscale are slowly ramping up. Each new institutional entrant compounds demand. When wirehouses start letting financial advisors allocate client capital, ETF inflows could spike further, accelerating scarcity and price growth. This is no ordinary market cycle, it's a structural transformation. Global adoption is also picking up. The UK is implementing a framework for crypto, learning from early movers, and allowing regulated stablecoins like RLUSD to operate in their financial system. This is important because it demonstrates global interoperability. Meanwhile, USDT's downgrade to the lowest stability rating by S&P highlights systemic risk in unregulated stablecoins. When risk rises in legacy stablecoins, institutions and investors will move towards safer options, and XRP is perfectly positioned to benefit from this liquidity migration. XRP isn't just another digital asset, it's a settlement rail built for regulated liquidity flows. Its technology is designed to support banks, fintechs, and cross-border payments efficiently. That's why institutional adoption matters more than retail speculation. When the market realizes this, capital allocation shifts dramatically. Investors who understand this infrastructure can position themselves ahead of the crowd rather than reacting to price charts alone. Even technical analysis supports this thesis. Yearly XRP charts are forming a cup and handle pattern, one of the strongest bullish indicators in financial markets. Combined with regulatory clarity, institutional ETF inflows, and supply reduction, the technical setup reinforces the structural story. This isn't about short-term hype or momentum swings. It's about multi-year positioning for real wealth creation. Let's also remember how capital behaves during structural shifts. Institutions don't chase small retail candles. They quietly accumulate, building positions until liquidity starts to tighten. Once scarcity hits, price discovery becomes forced, and even minor buying pressure can create massive upward movement. The more XRP is locked into ETFs and custodial storage, the fewer units remain in active circulation, making every transaction on exchanges more impactful. Meanwhile, XRP continues to benefit from global regulatory clarity. Switzerland, Singapore, and Hong Kong are all actively supporting crypto infrastructure, while the UK is now stepping into the game as a strong second mover. Global alignment in regulation and adoption is building a pipeline of long-term demand for XRP. This isn't a story that will unfold over days or weeks. It's a multi-year accumulation phase where patient investors stand to gain the most. The key takeaway is simple. The quiet phase of accumulation is where the asymmetrical opportunity exists. Understanding supply dynamics, institutional behavior, regulatory clarity, and global adoption is far more important than reacting to daily price swings. XRP isn't just climbing, it's being positioned as a foundational asset for the next generation of global financial settlement. Let's now shift our focus to stablecoins and why they matter for XRP's long-term positioning. Stablecoins like Tether, USDT, have dominated crypto markets for years, providing liquidity and acting as a bridge between fiat and digital assets. But recent developments have exposed vulnerabilities. S&P Global downgraded USDT to the lowest stability rating, citing transparency issues, reserve risks, and exposure to volatile assets like unsecured loans and Bitcoin. This is a red flag for institutional investors who need safe, reliable rails for large-scale transactions. When confidence in USDT wavers, the market looks for alternatives that are regulated, transparent, and capable of handling real-world settlements. This is where XRP comes in. Ripple's ecosystem is uniquely built to handle regulated liquidity flows. With its on-demand liquidity, ODL products, bank partnerships, and compliance-ready infrastructure, XRP becomes a natural alternative when unregulated stablecoins face pressure. Any stress in the USDT market could trigger a massive migration of capital to regulated options like USDC, RLUSD, and XRP-based liquidity rails. This isn't speculation. This is how institutional capital reacts to risk. When trillions of dollars need a safe corridor for movement, XRP's role becomes central. Even the recent Texas Bitcoin purchase demonstrates a growing institutional focus on crypto, but it also highlights a narrow mindset. Bitcoin is no longer the only asset capable of transforming financial infrastructure. XRP, Solana, Chainlink, and XLM are digital assets with utility beyond speculation. XRP in particular is directly integrated into cross-border settlement and enterprise-grade liquidity solutions. That gives it a strategic advantage over many other assets that remain purely speculative. The market is currently in what I call the quiet accumulation phase. Institutions aren't chasing quick profits. They are quietly building positions, taking advantage of dips, and ensuring long-term control over supply. This is crucial because supply depletion drives scarcity, and scarcity drives price discovery. With hundreds of millions of XRP moving into ETFs and custodial wallets, the circulating supply for retail trading shrinks. Every additional ETF inflow, every OTC acquisition, every institutional transfer increases upward pressure on price. The mechanics are simple: less supply, more demand, faster appreciation. Technically, XRP is also signaling potential for a major breakout. The yearly cup and handle pattern is forming, which historically precedes significant bullish moves. Combine that with institutional accumulation, ETF adoption, global regulatory alignment, and supply tightening, and you have a multi-dimensional setup. This is not about short-term hype or retail FOMO. It's about positioning for generational wealth. The patient holders who understand market structure, infrastructure adoption, and liquidity flows are in the best place to benefit. Global trends also reinforce this thesis. The UK, Switzerland, Singapore, and Hong Kong are building regulated crypto environments, creating corridors for cross-border payments and tokenized assets. Each new regulation, each new approval for institutional participation strengthens XRP's position as a trusted settlement rail. The narrative is clear. XRP isn't just a cryptocurrency, it's a global infrastructure asset. As banks, fintechs, and governments migrate capital onto these rails, XRP's utility and demand grow exponentially. Meanwhile, retail investors may notice volatility and wonder why the price isn't skyrocketing immediately. It's important to understand that bull runs don't occur in a straight line. Pullbacks are normal, healthy, and actually benefit long-term holders by giving late capital another entry point. XRP's growth is not about daily price swings. It's about multi-year adoption, liquidity migration, and structural integration into the global financial system. The takeaway is simple. XRP's value is increasingly driven by real-world use, institutional demand, and regulated adoption. Every ETF, every stablecoin migration, every cross-border settlement using XRP reduces circulating supply and increases scarcity. This quiet phase of accumulation is where the most asymmetric opportunities exist, setting the stage for explosive growth once liquidity constraints hit the market. Those who understand this infrastructure will benefit most, while those focused solely on price charts risk missing the bigger picture. Market matters for XRP's price trajectory. Institutional investors prefer to accumulate large amounts of XRP off-exchange to avoid moving the public market too much. These OTC desks currently hold an estimated 1.5 to 2 billion XRP available for institutional sourcing, but hundreds of millions have already been absorbed by ETFs and other buyers. This is a crucial point. Once the OTC supply depletes, institutions have only one option left: buying directly from the open market, where retail investors like us operate. That's when upward price pressure becomes explosive because demand remains high while available supply shrinks rapidly. ETFs and custodial wallets like Coinbase are acting as massive accumulation hubs. When XRP moves into cold storage for ETFs, it's effectively removed from circulation for years. These are not short-term trades. They represent long-term positioning. The more XRP that enters these wallets, the less is available for regular market trading, creating scarcity. Scarcity, combined with institutional demand, is one of the strongest drivers of price appreciation. This isn't hype, it's simple economics. As more ETFs launch and large capital flows into XRP, each new buyer has to compete for fewer coins, which naturally pushes the price higher. Institutional adoption is not just about money, it's about confidence. When Wall Street, regulated funds, and state-backed capital allocate to XRP, it signals legitimacy. Each ETF approval acts as a validation for other institutions. It says XRP is safe, regulated, and ready for large-scale settlement. This creates a compounding effect. More institutions want in, liquidity shrinks, and the market starts to price in future adoption. The quiet accumulation phase we see now is laying the foundation for a massive price move in the future. Meanwhile, regulatory clarity is accelerating. The US has opened structured access via ETFs, while countries like the UK are optimizing frameworks to encourage crypto use in payments, stablecoins, and institutional settlement systems. This is important because institutions only move capital when legal and operational certainty exists. XRP's infrastructure, compliance readiness, and banking partnerships make it one of the few assets positioned to benefit from this global trend. When the rails are ready, institutions will not hesitate to deploy trillions in dormant capital. It's also worth noting how these market mechanics differ from typical retail speculation. Price is increasingly being driven by automated systems, programmatic flows, and institutional buying rather than short-term traders. This removes human emotion from the equation, creating a more predictable, upward-biased trend over time. Unlike Bitcoin or other assets in early cycles, XRP is moving into a phase where liquidity scarcity, real-world utility, and regulatory adoption converge simultaneously. That combination is rare and historically precedes explosive price moves. Pullbacks, corrections, and sideways action in XRP should not be feared. They are normal and healthy in multi-year adoption cycles. Institutions use these periods to continue accumulating quietly, ensuring they build significant positions before the wider market realizes the scarcity. By the time mainstream investors notice, much of the available supply will already be locked away. That's when true price discovery happens, when billions of dollars in institutional demand compete against a shrinking liquid float. Finally, consider XRP's position as a settlement asset. Unlike Bitcoin or Ethereum, XRP is designed for cross-border payments, enterprise liquidity, and tokenized asset transfer. Its utility creates a structural demand that cannot be replicated by speculation alone. When OTC supply runs out, ETF and institutional demand hits the open market, scarcity spikes, and the price must adjust to match economic reality. This is the moment where traditional supply and demand economics collide with real-world adoption, creating one of the most powerful setups in crypto history. Let's zoom out and look at the global picture. XRP isn't just benefiting from US ETFs and institutional buying. It's part of a larger shift in how global finance is evolving. Countries like the UK, Singapore, Switzerland, and Hong Kong are actively building frameworks to integrate digital assets into traditional banking, payments, and settlement systems. Ripple's technology and partnerships place XRP directly at the center of these developments. The ability to move value quickly, cheaply, and securely across borders makes XRP an ideal asset for international liquidity migration. Every pilot program or cross-border integration expands XRP's footprint and signals growing demand from real-world participants, not just traders. Stablecoins play a critical role in this equation. Tether, USDT, has dominated the market for years. But recent downgrades and structural concerns show that institutions are looking for safer alternatives. XRP's network, combined with regulated stablecoins like USDC and upcoming CBDC-compatible solutions like RLUSD, creates a robust alternative for large-scale liquidity. If a major stablecoin wobbles, the capital will migrate to trusted rails, and XRP is positioned to capture a significant portion of that flow. This is not speculation. It's predictable behavior based on liquidity, trust, and institutional preference. The moment USDT faces even minor instability, the shift to XRP and regulated alternatives could be fast and massive. Meanwhile, the US has seen historic milestones with states like Texas officially buying Bitcoin for their treasuries. While this is positive for crypto overall, it also highlights where attention remains narrow. Bitcoin remains the headline grabber, but XRP, Solana, Chainlink, and XLM are quietly building utility-driven adoption. The capital that wakes up to this reality will flow into these assets, with XRP positioned at the heart of regulated global settlement. Unlike assets dependent purely on hype or speculation, XRP's value is underpinned by real usage, legal clarity, and growing institutional adoption. Another key factor is the psychology of accumulation. Most retail investors assume the market moves linearly. They expect predictable growth and obvious confirmation before acting. History tells us this is a trap. Early adopters, infrastructure-focused investors, and institutions accumulate quietly during the calm phases. Price may appear stagnant, but behind the scenes, supply is being removed from circulation, liquidity is tightening, and the foundation for a future breakout is being built. When adoption and scarcity collide, the resulting price moves are rapid and dramatic, often leaving latecomers scrambling. Technical analysis supports this macro picture. XRP's multi-year charts are forming a textbook cup and handle pattern, one of the strongest bullish setups in financial markets. When combined with shrinking supply, ETF accumulation, and institutional inflows, this technical alignment strengthens the case for a significant long-term rally. The market is not reacting yet because the quiet accumulation phase is ongoing, but the structural setup is clear. Those who understand these fundamentals recognize that this is not a short-term trade, it's a multi-year positioning strategy. We also have to consider the scale of global capital migration. Trillions of dollars sit idle in nostro accounts and legacy banking systems. Banks and institutions dislike inefficiency and trapped capital. Once digital rails like XRP provide a compliant, fast, and low-cost way to move that capital, it won't remain idle. Liquidity will be deployed into the most efficient path, which increasingly points to XRP. Unlike other assets, XRP is not just speculative. It is a functional layer for global value transfer. This gives it a structural advantage that few other digital assets possess. Finally, it's important to remember that institutional flows are programmatic and automated. Price is increasingly being set by real-world usage and liquidity demand, not emotional retail trading. Floors become higher, volatility becomes directionally biased, and when the critical liquidity point is reached, charts will look entirely different. This is when XRP transitions from an underappreciated digital asset to a central pillar in the global financial ecosystem. It's crucial to understand the bigger picture of what's happening with XRP and why it matters for long-term investors. This isn't about daily price swings or trying to time short-term pumps. The real story is structural. XRP is becoming a core part of the infrastructure for global value transfer. Institutions are quietly accumulating, ETFs are locking supply into cold storage, and stablecoin uncertainty is driving capital toward regulated and reliable rails. Each of these factors compounds, creating a scenario where XRP isn't just another crypto, it's a settlement asset with a unique role in the evolving financial ecosystem. The key takeaway is that supply is tightening, while demand is increasing. Retail holders may not see the full impact yet, but every XRP that goes into ETFs or OTC custody is effectively removed from circulation. When institutional demand continues to grow and OTC sources run low, the market will be forced to price scarcity. This is basic economic physics. Unlike Bitcoin, which has predictable mining supply, XRP's liquid float is being actively reduced while adoption grows. When liquidity becomes constrained, even modest inflows can create sharp price movements. That's the hidden engine behind the next potential breakout. Another important factor is global regulation. Countries are no longer experimenting. They are implementing real frameworks that support cross-border digital asset settlement. The UK, Singapore, Switzerland, and Hong Kong are aligning regulations with practical adoption. Ripple already has partnerships, technology, and legal clarity that fit directly into these frameworks. This isn't speculative. It's the kind of real-world integration that drives long-term institutional confidence. When pension funds, sovereign wealth funds, and corporate treasuries have a safe, regulated way to deploy capital, XRP is in the front seat. Psychology and behavior also matter. Many investors wait for headlines or confirmation, but by the time news breaks, early accumulators have already positioned themselves. Wealth is often transferred quietly. Those who understand infrastructure, network effects, and liquidity dynamics gain an asymmetric advantage. The quiet accumulation phase we are in now is where opportunities are largest. When price finally reacts, it won't be gradual, it will be explosive, reflecting the combined forces of scarcity, utility, and institutional adoption. Technical charts confirm this setup. XRP's yearly cup and handle pattern, combined with shrinking float and rising ETF demand, suggests a potential multi-year breakout. Unlike short-term traders, long-term holders are not chasing volatility. They are riding adoption-driven momentum. Patience is part of the strategy. Multi-year cycles are where significant wealth is created, especially when adoption and infrastructure are expanding globally. We also need to recognize the scale of capital migration that could occur. Trillions of dollars sit dormant in inefficient banking systems. Institutions will deploy this capital where speed, cost, and regulatory compliance are optimized. XRP's rails provide exactly that. As adoption grows, so does the network effect, making the system more valuable and drawing more liquidity. Once global settlement flows start moving through XRP at scale, price will no longer follow past patterns. It will reflect the total economic throughput of the network. This is why early positioning is critical. Finally, let's be clear, this is not hype or speculation. XRP's rise is driven by infrastructure, regulation, liquidity scarcity, and real-world adoption. The market is quietly shifting under the surface. Everyday investors are passengers in this transformation, unless they choose to understand and position themselves early. The window to accumulate before the broader market recognizes the structural shift is limited. For those who act now, the potential for wealth creation is enormous. In conclusion, XRP is not just a crypto asset. It's a fundamental part of the global financial rails being built for the next decade. Institutional adoption, ETF accumulation, stablecoin migration, and regulatory clarity are converging to create a perfect storm. The question is not whether XRP will benefit, but how much and how fast. This is the moment to understand, position, and prepare. History favors those who see the infrastructure before everyone else notices.